Strategy Room, Note 4, McKinsey 7S. The question this note opens with is not what is the strategy. It is whether the organisation is actually capable of delivering it. That distinction between intent and capacity is what Robert Waterman, Tom Peters, and Julian Phillips set out to formalise in 1980 in a Business Horizons article called Structure is Not Organisation. They were writing inside McKinsey for clients whose strategies looked sound on paper and were failing on contact with the organisation that had to execute them. The model they produced, 7 interdependent elements, became the 7S framework, and it is the internal counterpart to every outward-looking diagnostic in this room. The case we used to test it is BP under Murray Auchincloss, and the strategy reset announced on the 26th of February 2025. Waterman, Peters and Phillips were not trying to write a popular management book. They were trying to explain a recurring pattern. Firms changing direction, often after a strategic review of the kind McKinsey itself ran, were finding that the new direction did not stick. Structure had been redrawn, reporting lines had moved, and nothing material had changed. Their argument was that structure on its own does not constitute an organisation. 7 elements do. 3 of them they called hard because they could be specified on a slide. Strategy, structure, systems. 4 of them they called soft because they lived in the behaviour of people. Shared values, which in the original article was called superordinate goals. Style, meaning the pattern of senior management behaviour. Staff, meaning the composition and development of the workforce. And skills, meaning the distinctive capabilities of the firm. Richard Pascal and Anthony Athos were developing the soft side argument in parallel, published in 1981 as The Art of Japanese Management, and the two streams reinforced each other. The central claim of the model is easy to state and difficult to internalise. A change in any one element ripples through the other 6. Effectiveness depends on mutual reinforcement, not on the strength of any single element. The model does not prescribe a configuration. It does not say what your strategy should be, or how you should be structured, or what your culture should look like. It insists only that the 7 elements must point the same way. 2 years later, Peters and Waterman popularised the underlying argument in Search of Excellence, and the book sold in numbers that made the framework famous. The note here uses the original article because the article is more precise. Coherence beats brilliance. A brilliant strategy badly aligned with structure, systems, values, style, staff and skills will underperform an ordinary strategy that has been aligned across all 7. BP in 2020 announced what its then chief executive Bernard Looney called the Integrated Energy Company strategy. The headline commitment was to cut oil and gas output by 40% by 2030 against a 2019 baseline, and to build out renewables, electric vehicle charging, hydrogen and bioenergy. New segments were created, customers and products, gas and low-carbon energy. The strategy was real, in the sense that capital was reallocated, hiring was reoriented, and the company's external narrative changed. By February 2023, with oil and gas prices high and the European energy crisis still in recent memory, BP had already softened the production cut target from 40% to around 25% by 2030. The Financial Times reported the retreat at the time. Strategy had moved, structure and parts of staff had been reconfigured around the original direction. Already by early 2023, the 7 elements had begun to drift out of alignment. On the 26th of February 2025, BP issued a strategy update titled Focused, Simpler, Higher Value. The reset was substantial. Oil and gas investment would increase. Offshore wind capital expenditure would be reduced sharply. Approximately 20 billion United States dollars of non-core assets would be divested by 2027. Operating costs would be cut by between $4 and $5 billion annually by 2027. At the Capital Markets Day held the same day, Auchincloss used the words simplify and focus repeatedly. The strategic direction set in 2020 had been substantially reversed. The integrated energy company language was retired. The company described itself as an international oil and gas business with a smaller, more disciplined low-carbon portfolio. In 7S terms, strategy had moved for the second time in 5 years. The hard elements, structure and systems had to be asked to follow. The external signal arrived 2.5 weeks before the strategy update. On the 8th of February 2025, Bloomberg reported that Elliott Investment Management had built a stake in BP, reported at approximately 5%, and was publicly pressing the board for accelerated restructuring and improved returns. It is tempting to treat the Elliott intervention as a governance crisis. It is more useful to treat it as a capital markets reading of the same misalignment the 7S model would diagnose internally. Elliott was not arguing that BP's strategy was wrong in some abstract sense. It was arguing that the company's structure, systems, staffing, and capital allocation were not configured to deliver competitive returns under any coherent strategy, and that the gap between intent and capacity was now large enough to be a value problem. The market saw the misalignment before the disclosure did. Walk the hard elements through one at a time. Strategy, shifted twice in 5 years. The 2020 pivot away from hydrocarbons, the 2025 pivot back towards them. Each shift was internally coherent as a statement of direction. Neither shift was matched at the moment of announcement by a complete reconfiguration of the elements beneath it. Structure, segments were built around transition, customers and products, gas and low carbon energy. Those segment structures were retained, in modified form, into a strategy whose centre of gravity had moved back to hydrocarbons. A structure built for one direction is now being asked to serve another. Systems. Capital allocation frameworks and performance metrics had been recalibrated around low carbon returns, returns which Auchincloss himself acknowledged at the Capital Markets Day were below those available in the hydrocarbon business. The systems were still partly tuned to the previous answer. The inheritance gap in 7S language is that structure and systems lag strategy by design. They were built around the strategy that preceded the current one. Now walk the soft elements. Shared values. A workforce was recruited and promoted between 2020 and 2024 into a company that publicly described its purpose as energy transition. Those same colleagues are now being asked to prioritise hydrocarbon returns under a capital discipline frame. The values they joined for are not the values being asked of them. Style. The tone from the top has shifted from purpose-led to capital disciplined. Auchincloss's October 2024 interview on BP.com, Reset in Action, set out the simplify and focus language well before the formal strategy update. The style change is observable. Staff and skills. The technical bench was built for one configuration: renewables development capability, low carbon trading capability, bioenergy and hydrogen expertise. That bench is now being deployed in a company whose primary value engine is upstream oil and gas, where the skill profile required is different. Soft elements move slower than hard elements. That is not a flaw in the framework. It is the central observation of the framework. The board's question is therefore time frame as much as direction. How long will it take for shared values, style, staff and skills to align with the new strategy? And what is the cost of misalignment during that interval? The diagnosis that the 7S model produces is precise. BP's challenge is not strategy choice. The board can reasonably defend either the 2020 direction or the 2025 direction as a coherent reading of market conditions. The challenge is that successive pivots left the soft elements pointing in different directions from one another, while the hard elements were partially, but not fully, reconfigured around each successive choice. The result is a system state of partial alignment, with no single coherent configuration. That is what Elliott saw. That is what the share price reflected. That is what capital markets read before management disclosure made it explicit. Misalignment at scale is visible from outside the organisation, sometimes before it is fully visible from inside it. This is where the non-executive role sharpens. The 7S model gives the board 3 questions, not one. First, which elements are currently misaligned? That requires a structured assessment, not a narrative. Second, what is the plan to realign them? Element by element, with named owners and a sequence. Third, over what time frame? And what is the evidence base for believing the soft elements can move at the pace the plan assumes? The third question is the one most often skipped, because soft element change is hard to evidence in advance. But it is the question that distinguishes approving a direction from testing whether the organisation can deliver it. Approving direction is the easy half of strategy oversight. Testing capacity is the harder half, and it is the half the 7S framework was built to support. 3 things to take away. A reading. Read the 1980 Waterman, Peters and Phillips article alongside BP's strategy update of the 26th of February 2025. The article is 13 pages. The update is the test case. Together they take an evening. A question. When did your board last receive a structured alignment assessment of the 7 elements against the strategy currently approved? And was the soft side evidenced or asserted? A pointer. Strategy Room 03 on Porter's 5 forces is the outward-facing counterpart. 5 forces identifies where a defensible position exists. 7S tests whether your organisation can occupy it. The two frameworks belong on the same agenda. Curated by Matthew Doyle, Made Partners.